Will gold finally fight back against the US dollar? Well, the US dollar has been a stronger safe haven asset recently, powered by the Middle East energy crisis, keeping gold on the defensive. But this week, the focus will turn back to the calendar, with traders watching closely the US non-farm payrolls report due this Friday in a relatively short trading week as Western economies are celebrating Easter holidays. While key economic data, including Japan's business PMI figures, the US ISM business PMI data for the manufacturing sector, as well as Eurozone's flash CPI inflation data, could also add extra volatility in global markets. So let's have a look at what the chart suggests and what's the technical outlook for gold, USDJPY, and Eurodollar. And starting first with gold and the US non-farm payrolls report, well, the data are expected to show a moderate recovery of around 55,000 new job positions in the US compared to the minus 93,000 job loss that was reported back in February. While in other indicators, the unemployment rate could remain stable near 4.4%. Wage growth may also hold steady near 3.8%. So overall, investors expect a relatively stronger jobs report. But if the data disappoint, then that could be positive for the precious metal, which has been suffering from a stronger dollar in precious metals. As we can see, the precious metal is currently pushing for some recovery. The technical indicators have already reached oversold territory and have turned higher. So the key question now is whether that recovery will continue the coming days. We still have geopolitical risks on the background. The war with Iran, continues, and there has been more escalation during the weekend. So geopolitical risks could also weigh on the precious metal. But in the meantime, the price is pushing higher. We're currently approaching the 4,650 resistance territory, which includes the 23.6% Fibonacci retracement level of this rally that started in late 2022. And once we surpass this, then I believe that we may have a stronger battle near the 4,800 territory, where the 20-day moving average is heading. A break above that could confirm additional gains towards the 4,960 and 5,023 barrier. The 50-day moving average is located here, so another victory could actually lift the price higher. And maybe in this case, we would like to see a clear close above this tentative resistance trend line near 5,230, a break of which could signal a bullish continuation. But in the meantime, we're still far below this territory, and despite the improvement in the technical indicators, the RSI is still below 50, the MACD is still below the red signal line. So downside risks haven't actually disappeared. Once the price falls below the 4,375, then we could see an extension back towards the 4,118 and 4,190 zone, where the 200-day moving average is placed. That line helped the price to pivot higher last week, so it would be a symbolic territory to watch. And perhaps slightly lower, the 3,930 and 4,000 territory could also protect the price from a more aggressive decline towards the 3,600 level, where the 50% Fibonacci level is located. Now looking at dollar yen, well, dollar yen could also face volatility from US data releases, including the US jobs report, as well as the ISM manufacturing PMI survey, which will also include some extra clues about prices and employment. But in this market, we also have the risk of FX intervention from Japanese officials, which aim to strengthen the yen. As we can see, the price hit a new high at 160.45 earlier today, but then it moved lower, indicating that traders remain cautious, probably because of the FX intervention risks. Nevertheless, we are still within this bullish channel. The price is still supported above 159 and perhaps above the 158 territory, a break of which could activate fresh selling towards the 50-day moving average near 156.65. Then below that, the 155.50 territory could also protect the price from additional declines towards 154.50 and even lower towards the 200-day moving average, which is approaching the 153 number. Well, as we can see in the technical indicators down here, we can see some weakness persisting, especially in the RSI. The stochastic oscillator is set for a negative reversal, and the MACD has yet to climb above its red signal line. So that keeps some caution, a technical caution in place. Nevertheless, if US data surprise to the upside and Japanese officials don't intervene in FX markets, we could see a rally towards the 161.88, 162 zone where the 2024 high is placed. Then beyond that, I would keep a close eye on this resistance line near 162.75 before targeting the next barrier around 163.50. And don't forget that we also have Japanese Tokyo inflation numbers coming out later this week. Although the data are weaker market movers, perhaps those might be interesting to watch given that the Bank of Japan is still willing to raise interest rates. And finally, looking at euro dollar, which has been on the back foot, while the focus in the Eurozone will be on the CPI, flash CPI inflation numbers for March. Forecast suggests a significant rebound to 2.7% for the headline inflation compared to 1.9% previously in February. That would be, if true, that would be a significant rebound in inflation, but the core measure is expected to ease slightly to 2.3%, suggesting that the increase in energy prices has yet to be transmitted to consumer prices. So a higher headline inflation may not cause strong volatility. Perhaps the core measure should also shift to the upside to cause a rebound in euro dollar. And from a technical perspective, for the bias here is still skewed to the downside. The RSI is below 50. The stochastic oscillator is moving to the downside, and the MACD is also heading towards its red signal line. So overall, the market keeps lacking bullish pressures, especially after the rejection near the 1.1630 territory, which in the weekly chart that coincides with the 50 weekly moving average. Well, now, if the weakness persists, if the data surprise to the downside, suggesting that rate hikes are not necessary yet in the Eurozone, then the price could retest the 1.14 base, which managed to help the price earlier this month. Failure to hold here could drive us probably towards the 1.12 and 1.1280 zone. That was a key barrier back in May 2025. So that area could be the next target on the downside. So while lower than that, the 50% Fibonacci mark near 1.1125 was also a key support territory back in May 2025. So that will also be closely watched in the event of a steeper decline. Now, in the event of if the core measure, CPI measure, surprises to the upside, perhaps that could help euro dollar to move higher and retest the 1.1540 territory, where the 20-day moving average as well as this resistance trend line are placed. Beyond that, the price may head back towards the 1.1630 territory. While I believe that a significant close above the 1.17 number and beyond the 50 and 200-day moving average could be a bigger achievement for euro dollar, likely helping the pair to run as high as 1.1820. So that's everything I wanted to share with you guys. Keep a close eye on the calendar, on the US non-farm payrolls, Eurozone CPI inflation numbers, and business PMI figures, as the week includes also geopolitical risks and probably interest rate signals. So that's all from me. Thank you for watching, and we will be back soon on Thursday for more technical updates. Bye bye for now.